Okay, so very good morning. Welcome to Super Thursday, 4th of August. Potentially then in for a historical day for many of you, because for the first time in a long time, I think it's about 77 months, this chart is about to change. This flat line, dead graph almost, since 2009 today is about to potentially have a little kink in the bottom of another 25 basis points. So before we get into the Bank of England though, because there's quite a lot to get through on that particular subject, I just want to have a quick look at the crude oil numbers from yesterday, particularly because of the price action that we saw. First of all, let's just have a look at the chart itself. And so this was the initial reaction to oil. And then why did that happen? So I know I've spoken to some of you individually, but obviously the first reaction that we had was a spike lower in prices, fairly aggressive in nature. And the reason why that occurred, if I just bring the numbers from yesterday into shot, was that the DOE's headline crude number was in fact a build of 1.4 million. So once again, what should be hypothetically a correlation between the API headline reading and DOE fell apart because the API was a drawdown. This came out as a build, and although we'll go into it, there's some other bullish factors within this report. The market always acts first to the headline reading. That's because that's the first one that people see. It's the first one, I guess, that if there was any type of high frequency model reacting, that would be the first number, and given it was so far away from what was priced in, i.e. a similar size but a drawdown, that's what caused then the initial spike lower. However, as you can see, in terms of crude as a whole, we ended up making a very decent push. We came back to around pre-announced levels, settled slightly, but as the US session progressed, we continued to move higher through the resistance levels and then also through $41 to the upside before petering out in overnight trade in Asia at around 41.17. So again, why did that happen? Well, as ever, when I kind of give you guys the rundown of trading the crude oil numbers, the reason why it's so difficult to trade is because it's because of the amount of components that you need to be aware of within the data set as a whole. So after the market initially reacted to that, the first thing that I heard after that number that stuck out in my mind was the gasoline number. Because the gasoline number in APIs was nothing to the size of the drawdown that we saw. It was something more like 500,000 or so, and this came out obviously a draw of 3.262 million. So instantly I know that's a more bullish factor. Now, although obviously we're looking at crude futures, WTI, if gasoline futures spike aggressively enough, it does tend to lift the rest of the energy complex in sympathy. But then when the other numbers I heard squawked, the one at the end, which also I thought was most important, was this one here. Crude output fell 0.646% to 8.46 million barrels per day. You know, I've been talking about US output a lot in the last few weeks because in this weekly inventory data, that's really been the driving factor that's moved the price of oil. And that's because we had 3 consecutive weeks of oil increasing after a definitive trend to the downside that's been seen since mid-2015. The problem is the market had got accustomed then, after 3 consecutive weeks of output going up, that they were looking for the same thing to occur again, but that was far from the case. Now, over the last 3 weeks, cumulatively, we added around 1% in terms of US output. In this one reading of the week from yesterday, it fell 0.646%. So almost 2/3 then wiped off from what we've seen built up over the last 3 weeks. And that was the bullish signal, I think, for prices to push on, in combination then with gasoline over emphasized the fact that we had the build on the headline figure. So that kind of hopefully explains a bit more detail as to why that occurred in terms of the oil move, the quick bounce. The actual trade there was around the $40 handles when it came back. I think Will traded it live with you guys. He was on the mic at the time. It came back to 40, then he went long and managed to get on the back of that trade to ride it back up. In terms of US equities then, managed to eke out into positive territory. The Dow, as mentioned yesterday, statistically an 8th day to go down again would have been the first time in around 5 years or so. So that did not occur. The Dow finished in slight positive territory, snapping that 7-day losing streak. Now, quickly this morning, looking at the index futures, the DAX has seen a small gap higher. So why has that occurred? Well, one of the biggest, Europe's biggest engineering company, essentially, Siemens, one of the largest in Germany, has raised its earnings outlook for the second time this year after posting higher than expected third quarter profit and a jump in large orders for power generating equipment. Don't forget, we're in an environment where economic growth is supposedly slowing, and companies making large scale investments, you would think they'd be a little bit more cautious after the back of Brexit and knock-on effects that might have in Europe, and then obviously the Italian ongoing concerns in their banking system. But Siemens continues to outperform, and when the company is such a large market capitalization in the DAX index and in Europe overall, that's what's caused a bit of a move higher here this morning. Combination with that, another large cap German name, Merck KGaA, they posted their second quarter profit that beat analyst estimates. The prescription drug division's earnings climbed. That prompted the German company to raise its forecast for the year. Now, I haven't really seen many companies raising forecasts this earnings season. But this morning you've had the likes of Siemens, Merck, big companies in Europe. Serco, I'm just seeing flashing on FT, their shares, the UK listed company, up 16% after an earnings upgrade. So certainly there's a couple of names out there helping lift sentiment slightly. However, there is a looming risk event forthcoming, and that being the Bank of England. Will they disappoint? Will they deliver? Or will they over-deliver? So at the moment, just keeping an eye on this DAX. We've just broken that initial low, so from here be looking for it to realistically close the gap, then potentially come back to 10,200 at least here. Okay, moving on then to the main event, that being the UK and the Bank of England. What exactly will they do today? Now, I thought what would be best to do to explain the situation is look at some of the data that we've seen. Now, somewhat against the way that the market was positioned, but in line with, I'd say, the majority of economists, the Bank of England decided to hold interest rates last month. So they decided that they wanted to see more economic data to make a more informed decision thereafter and how they will use policy to counter the downturn of Brexit. So rather than going in blind, they wanted to see some sort of assurance to see how severe is the downturn. Well, these next couple of charts paint a very pessimistic picture for our economy. UK services, as you can see, the blue line, we've had that data. The economy, as I've stressed before, is pretty much 70 to 75% dependent on this sector. And when looking at where it is tracking at the moment at around 47.5-ish type level, we are well below the European sovereign crisis low. We are at levels that were seen during the subprime crisis. If you start looking at manufacturing, we're not quite as bad. That has held up slightly better. Not quite to the lows that were seen in 2012, but again, remember 50 is the key between expansion and contraction, and we're certainly back below 50. Construction, again, worst pretty much since 2009 once again. And well, there's one chart here that I wanted to look at was Bank of England policy decisions and the PMI. So you can see here the dark blue line, if you like, is the PMI data. Now this is one of the main metrics in which the Bank of England will be looking at in defining its policy going forward. And if you look at the aggressiveness of the decline here, where we've moved to the downside more recently through those 2012, 2011 lows, certainly back to subprime type levels, albeit that was a much more dire situation, you can see here the two phases where the Bank of England have adopted quantitative easing. One was in response, obviously, to the financial crisis. That was the program being introduced, Bank of England being one of the first, along with the Fed, to bring that into fruition. And then you had the strong recovery in the PMI data. Then during the kind of fallout between the bailouts of Greece and other European nations, they then restarted the QE presses again. And since then, it's been put on ice, so to speak. At 375 billion is where they last left it. Now, one important thing with QE, for those who haven't seen it before, is the increment that they normally tend to move in, the Bank of England. That is between 50 and 75 billion when they tend to increase it. So if there was a QE announcement today, it'd be likely the Bank of England would say, we're going to do 50 billion over X period of time, or we're going to do 75. Or if you're Goldman Sachs, they're saying they're going to do 100. But they are much more on the dovish end of the spectrum in terms of the size of the QE that could be announced than other investment banks. The one thing I think this graph really does highlight, though, is forward guidance. You can see was the red. This is when Mark Carney came in. Look how forward guidance has performed for the PMI data. As soon as he unveiled that, PMI started moving lower. So it's been pretty ineffective from a policy point of view. Looking then at a few other interesting ways to look at this and how the market is currently positioned. So 50 of 52 major investment bank economists are expecting a cut to interest rates. Market pricing last week was 100% probability for a cut. When I last looked yesterday, it was tracking at around 98%. Now, that does not mean that a rate cut is assured. There is always a possibility that they could hold interest rates and play on the premise of delivering an uber dovish press conference and projections in their quarterly inflation report to suggest they're willing to do as much as it takes or whatever it takes should the data continue to worsen. Maybe it's just a case that they want to see a bit more information before making that call on whether to restart the QE or cut interest rates. So overwhelming though majority going for a cut. Now the thing you'll get this time around as well, and it's going to make trading this event fairly complex, is that after you get the interest rate announcement, the potential QE announcement, also key is going to be the vote split, because obviously there's a sliding scale of dovishness that if they decided to do, say, cut interest rates and it was 9-0, all MPC members looking to cut, that's the most cleanest, let's say, dovish scenario the vote could come in. But if they were to have voted 5-4 to cut, that is obviously what we were talking about last time. That would be a dovish or a hawkish cut, so to speak, if it was 5-4. So the vote count's going to be important. But then, after that, at 12:30, you'll also have to digest the quarterly inflation report. And it's two real metrics you're looking at here. And the first is what we're looking at on this chart is growth. Now, what you can see here is the GDP forecast in November of 2015. That's the far left, the dark kind of orange or tan. Then the blue, February. Then the orange is May. And then the teal colour here is the latest Bloomberg survey. So these are the last 3 quarterly inflation reports. And this is where we're projected to be. So you can see we're expecting pretty much the biggest downward revision to growth that we've seen so far in more recent quarterly inflation reports. Certainly 2017 and other, I would say, think tanks and industry bodies have felt the same. That's when we're going to see the most severe downturn in the economy. Now remember, monetary policy, whether it's cutting rates or doing QE, takes time to filter into the economy. The main reason that a lot of these calls on the street that they will cut and do QE announced today is in order to get ahead of the curve to counter the expected downturn in the back end of this year, certainly in 2017. Because if you delay it and the economy continues to get worse, obviously you're going to be propping up the economy from a much worse position. Surely it's better to get ahead of the curve and get, you already know the economy's slowing, is get the stimulus measures into place now. The other point though here with the core inflation report, the other one of the two things to look at, not only growth expected to be downgraded fairly significantly, is inflation. Now, inflation is quite a good telling sign for the interest rate path in the Bank of England. The problem is that because of the 10% depreciation of the pound post-Brexit, from going from 150 type levels to 133 where we trade at the moment, is that hypothetically that should result in a spike in price pressures and therefore higher inflation. The key here is that the Bank of England gives a 2-year horizon of their inflation forecast. What that means is then, do we just see a blip in inflation and then it returns back to a more steady level, or do the Bank of England see a more lingering inflation effect from the sharp pop lower that we had in the pound? If that's the case, and they foresee higher inflation for a longer period, that is obviously a more hawkish situation. If they see though that the pound's drop will lead to only a momentary or transitory, let's say, pop in inflation in the UK before it then comes back down, that could be seen then as a more dovish sign. So there's a couple of different ways to look at this, and from a market pricing point of view, this is quite an interesting chart because I've heard a lot of people on Bloomberg TV already talking about it this morning, and that's hedge funds are the most bearish on the pound at the moment. So net shorts, this is speculative futures trades, net short positions have reached a record before today's decision. So the market is its most heavily short in the pound that it's been ever. That means that can Mark Carney realistically not cut rates when the market is pretty much 100% sure of that? The movement in the pound, if I just start to bring that back in. So let's just have a quick look at what would happen if they don't cut rates. Well, we're trading at 133. I think if they don't cut rates, you would see likely an instant spike towards the top end of this range. That's 135. That's the range we've had and held since mid-July. The only problem is if they don't cut rates, I don't think you're going to see a sustained upward move in sterling. Because if you don't cut rates and you want to buy more time, then I think they would be super dovish in their communication in the press conference. So ultimately, because the market is positioned so short, I think you'll get an aggressive pop higher, and then you'll get a drift lower and ultimately a sell-off on the premise that the Bank of England will have to do more in the long run. Also, the economy's only going to get worse, which is mean they're going to have to do an even bigger, more aggressive form of easing later on down the line. So I think the upside somewhat is more limited. If they cut rates, you might see a blip lower on confirmation, but then it's down to the vote count and what else do they do. If they only cut rates and don't do QE, again, you might get a situation with the fast money blip lower and then a rally. And then we're going to have to wait till 12:30 to see whether he tries to be, again, dovish to give the sign that QE is still very much on the table if it's needed. The vote count, obviously, as well, is going to be important for the size and magnitude of the initial spike in either direction. Again, 5-4, less than convincing, would be seen as more hawkish, 9-0 more dovish. Now, there are other programs that the Bank of England can use. Just reading the Deutsche Bank note this morning, they say, among additional measures at the bank's disposal are other forms of asset purchases, for example, corporate bonds or LTRO-style liquidity operations. Now, one thing you've probably heard mentioned before with the UK, but might not fully understand, is funding for lending. I found this article, it's a bit dated, from the BBC, but it's a good explanation of what exactly that programme is. Because possibly the Bank of England doesn't opt to do QE and extends the funding for lending scheme. Because ultimately, QE has come under a bit of question marks on, has it actually done its job? Also as well, there's a lot of people out there who are very pessimistic about what use is a 25 basis point rate cut. Now, the funding for lending scheme is interesting because it aims to increase bank lending by a significant amount. £70 billion was the initial kind of target. This programme did get extended for a further 2 years back in November of 2015. So how does it work? In essence, the Bank of England is letting commercial banks borrow funds from it cheaply so that banks can then pass on in the form of cheap loans to firms. The mechanics: banks and other lenders approach the Bank of England if they want. They swap assets they already have, such as loans with the bank. It in turn provides them with pieces of paper called treasury bills for a 4-year period. The commercial banks are then able to use these paper as top quality backing, which to borrow cash in the wholesale financial markets from other lenders with the treasury's backing. The idea then that they'll be able to borrow funds at a very cheap rate. Now, if anything, this is almost, in my opinion, a more targeted way of really hitting the lifeblood, which is the SMEs, if you like, of the economy, which struggled the most in tight credit conditions. And so what I'm suggesting then is that potentially you could get a cut in rates and some questions, or let's say an extension to the funding for lending. Rather than immediate QE, the Bank of England may opt to then suggest that they'll do QE in the future. So that's also a distinct possibility. Okay, just to quickly wrap things up, to make things even more complicated, I did a survey this morning just to see how you guys are feeling about what you expect. And there's only been 22 votes, but you guys are pretty split, and I don't blame you for the highest amount, 41% saying no action. So far, we've only been disappointed by the central banks. But in the run-up to this briefing, when I was thinking about what to say, I'm going to have to put my neck on the line here. I think they will cut rates. And I think that QE, I'm not so sure on. The funding for lending scheme, I think, might be extended. And then I think they'll be dovish in their press conference to suggest that they want to see more data, and then only then will they restart QE. So putting it out there, let's see what happens. Obviously, you guys, the majority, are saying no action at all. You're fitting in the 2% by going with that. But again, I can see you're thinking, given the disappointment from the ECB not doing anything, kicking the can down the road, and the inaction from the BOJ. Only 5%, the real minimal, going for the full Monty today, which is what Bank of America are calling for. Okay, guys, been speaking for a while, so going to wrap it up there. I'll be back on ahead of the main event to go over it again in a bit more detail. But my kind of feelings for this morning is I wouldn't be too aggressive jumping into market moves this morning. You're probably going to be best placed to save your ammunition. There's going to be lots of price activity. What the Bank of England do or do not do, given the variety of options, given no real clarity on the extraordinary measures they could do to supplement a rate cut, means that there's going to be a high degree of volatility. Okay, good luck with the event, and I'll be on the mic guiding you through. Have a good session.